Hey there. Today we're going to do a video on the John Hancock hybrid long-term care and life policy. I'm Drew Nichols. I'm here with my cousin slash business partner at LTC Tree, Derek Wilkins. Hey, Derek.
Hey Drew, how's it going? Yeah,
It's,
thanks guys. Today we're going to talk about a couple of the hybrid long-term care insurance products that your advisor you might have found us because your advisor showed you one of them. One of the first one is the John Hancock USAA product. So USA often recommends the John Hancock kind of hybrid product. Lincoln MoneyGuard Fixed Advantage, that's the name, and Nationwide Care Matters too.
yeah, and some advisors even sell the Lincoln Market Advantage as well. So got a couple different plans. We're going to do a quick review. What we find is a lot of people come to us at LTC Tree to get comparisons of all the companies side by side because that's what we do. That's kind of our reason for being out there. So we do these side by side comparisons, and oftentimes we're running into. We'll start with this John Hancock plan that USAA recommends. USAA underwrites a lot of their own products, like their home, their auto, and those types of things. But when it comes to long-term care, they outsource it to John Hancock. So we'll talk about this plan, some of the pros and cons of it here to start with. What would you say is the biggest pro of the John Hancock plan, Derek? I'm just trying to think myself. I got some ideas.
Yeah. From when you do something for 25 years, like I've been doing it straight out of college in 1999, you run across all these plans. We've used this tool several times over the years. The common place for the John Hancock hybrid long-term care insurance plan is going to be for clients who are more life insurance focused. Having a bigger life insurance payout is more important to them than long-term care insurance because it does give the most life insurance, but you sacrifice the long-term care benefits. But some people, that's what they want.
Yeah. So if you like a big headline number and that's important to you, the John Hancock can make sense. But there are some downsides with this one, and I think I'm actually I'm gonna share a quote here that we've got. This one was from a little bit back, but the thing you need to look out for on any long-term care plan is you want to look for in my opinion, you want to look at the guaranteed charges and guaranteed rate page to see what the worst case scenario with the plan could be. And what this means is that the plan has a certain fee schedule, and if they max it out to the most fees that you would pay, the plan you pay your premium of $6,092 every year, but eventually the plan at this client's age 23 years out at age 85, this plan just melts down and becomes worthless. Now, that's not likely to happen at year 23, but it is something I think people should be aware of. What do you think, Derek?
Yeah, and if you, I don't know if you can flip back in a minute or two, but there's a page in there that has a guaranteed expected rate of return that Hancock's actuaries have crunched, and it's usually in the 5-6% range, and that's what they're anticipating they're going to be able to earn on the money for the next 25 years. If that happens, then all is good. Your policy will continue. But if it doesn't happen, you're going to be faced with your policy expiring when you're 85 years old, right when you're about to need it, or you have to put more money into it. So it's kind of an interest rate risk. But the positive of this John Hancock plan is you could probably get away with putting in a little bit less premium. Like, in fact, this example, you could pay a lifetime premium versus the two plans we'll talk about in a second, the Lincoln MoneyGuard and the Nationwide. You got to pay over 10 years.
Yeah, and I mean, if you look at the numbers on this, assuming that it doesn't have the worst case scenario of $6,100 in premium going away at year 23, paying $6,000 a year for $300,000 in life insurance that can also be used for long-term care is pretty amazing deal. Now, the page you were talking about, Derek, is this next page. This is based off of current charges, which are probably lower than on the guaranteed amount. So you're going to get a higher benefit, and then an initial assumed rate of 4.85. So you mentioned that there is an interest rate risk, and that's exactly kind of the concept we're covering here. So if everything stays hunky-dory like it is right now, the plan, I don't see any pound sign. It just keeps going forever. Just goes until age 106. So yeah, that there's some advantages to this plan if everything works out as as currently projected.
Yeah, and a couple other items I want to point out on the John Hancock plan is the other one's going to be it's a reimbursement policy versus Nationwide, Minnesota Life, Bright House. Those are cash indemnity. What that means is reimbursement. It means if you have a $6,000 nursing home expense, your John Hancock is paying you in this example $12,000. They're just going to pay you the $6,000. A cash indemnity means if you had a $6,000 expense and you had a $12,000 monthly benefit with, say, Nationwide, Nationwide is just going to send you the full money, and you can spend the money on whatever you want. You don't have to submit receipts. With this John Hancock plan, you do have to track down receipts and then submit them to the insurance company for reimbursement. It also comes with a 90-day waiting period. And lastly, on the John Hancock plan, you have to use licensed state-approved caregivers.
Yeah. And full disclosure, I own a reimbursement policy. I think you had one for your parents as well, Derek. Reimbursement is not the end of the world, but we have the advantage of talking to literally thousands of people over the last few years. And I mean, I would say most people's, probably the thing that annoys people the most when they're making a claim is having to deal with all that paperwork.
Yeah, and that kind of brings us to our next product we're going to review quickly. That sometimes your financial advisor might show you is the Nationwide Care Matters 2 product. That's more long-term care insurance and less life insurance. For a 60-year-old male, probably if you gave Nationwide $100,000, your life insurance benefits are probably going to be 110, 120. You're not going to get rich. So life insurance is much less than the John Hancock.
Right.
But the Nationwide, they're going to start you off with $300,000 to $400,000 of long-term care benefits paid to you in cash, and that's going to increase 3% compounded over over your lifetime. So your benefits will double in 23 years versus the John Hancock plan. It's just going to be a flat $300,000. It's never going to grow.
Yeah. So if you're worried about planning for long-term care and life insurance is secondary, which is honestly most people I talk to say, I've got life insurance, I don't care about it. And I'll say, fine, this isn't really life insurance. It's almost like return of premium in a lot of cases through the death benefit, de facto. The Nationwide Care Matters 2, the Lincoln Money Guard, the Securian Secure Care, these are all three almost clones of each other. They have different nuances and pros and cons, and we can cover that specifically for a specific client. But in general, the numbers that you just threw out, Derek, are spot on. And if you do the math on it, that means they're going to have $500,000 to $750,000 at average claim age in long-term care benefits with that type of plan.
Yeah, and to your point, Drew, they're going to have that benefit to their most important benefit for them, the one that they're most concerned about. You're going to have the most long-term care, because I hear that we talked to, like I said, thousands of people. Almost everybody says, I'm more concerned about the long-term care and less the life insurance. So that's where you want to kind of maybe get the quotes from your advisor. But if you're watching this video, it means you found us. We're objective. We sell them all. And we got to go over the pros and cons of each. The last product I want to quickly touch base on. Drew, you want to tell us about the Lincoln product?
Yeah. So the Lincoln Money Guard.
What's it called?
So which one?
The Lincoln. The Lincoln.
The Money Guard?
Yeah, it's called another. It's called the Lincoln Money Guard.
Market Advantage.
Okay, gotcha.
Yeah. So Market Advantage from Lincoln is a product that we don't sell because we sell guaranteed, locked in policies. It's actually a variable universal life insurance, which the variable is the thing that you need to be very cautious with because it's linked to market indexes, and your benefits can actually drop a little bit in some cases. So it's to me, insurance is something that you're locking in, and at least you know what your benefits will be in the future. Having that variability and having numbers that are lower than what was projected when you bought it is a little scary.
Yeah, and I agree because again, to your point on if somebody has $1 million net worth, you're not putting the vast majority of your money into like this insurance product. You're only putting 10% in that example of your money in there. The other 90% can stay in the variable investments, keep on doing what it's been doing. But a lot of our clients want the guarantee that, hey, my insurance already got 90% of my money in assets that are variable. I want some guarantees attached to this portion. They don't have to worry about it.
Right. Yeah. So that's exactly. We're solving the problem of taking a tiny little chunk of someone's assets and protecting as much of it as we possibly can with a fixed, guaranteed product. So, I think the gist of it is, like you said, if you're watching this, you found us, we give specific quotes to specific situations, and these things change like week by week. We just got an email from one of the companies who we will go unnamed because it's not public yet, that they're making some changes to their rates in a couple of weeks. So if you're shopping for this, it's definitely a good idea to get a second opinion from somebody like us at LTC Tree, in addition to your financial advisor. We work with people who have financial advisors every day.
Yeah, and we've been doing this a combined almost 50 years. I started doing this out of college, as I mentioned. Drew came in a few years later, and we're objective. I mean, we work for you, not one insurance company. We'll go over the good, the bad, the ugly with all these products, and kind of just help you shop around with one source.
Yep. So we'll wrap this video up. Again, if you're looking at the John Hancock in particular was kind of the one we focused on, reach out to us for a second opinion, and know that there are pros and cons with really any of these policies. So we'll wrap it up. Thanks, Derek.
All right, see you, Drew.
Bye-bye.